The Greenbrier Valley of West Virginia is a farming country that most people who know American agriculture, primarily from the flat grain states of the Midwest, would find surprising, because the farming happens in the specific way that farming happens in the Appalachian Mountains, in the valleys and the bottomlands between the ridges, on ground that produces well when it is managed correctly and that does not forgive the kind of overextension that the flatland farming country to the west sometimes survived. The farms of Greenbrier County in the early 1980s were mostly the mixed operation, farms that the mountain country produced, grain and hay and cattle in the specific combination that the terrain and the climate supported, operations that were smaller in total acreage than the Midwest grain operations, but that were productive on their specific soil, and that had been farmed by the same families through multiple generations because the mountain farming communities had the kind of persistence that the specific difficulty of mountain farming selected for the John Deere dealer in Lewisburg, West Virginia, was running the 0% financing offer in the winter of 1981 when Harold Beckett walked in and looked at a new 4240 on the showroom floor and thought about it for a long time before saying he would have to think about it. The dealer's name was Gene Prater, and he had been selling John Deere equipment in Greenbrier County for 22 years, and the 0% promotion had been the most powerful sales tool he had run in those 22 years because it solved the problem that the 17% interest rate environment of 1981 had created for every farmer in the county who needed equipment. 67 was an age at which many Greenbrier County farmers had been thinking about succession and about whether to make the capital investments that keeping the farm productive required, or to wind down the operation and pass the land to children or grandchildren who would or would not continue the farming. Harold had not been thinking about succession in the winter of 1981. He had been thinking about the 4020 and what it was going to cost to maintain it through another season versus what it would cost to replace it. And the replacement arithmetic had been complicated by the interest rate environment that the Federal Reserve's inflation-fighting policy had created. He had been farming the Greenbrier County bottomland and hillside since 1951, which made 1981 his 30th year on the same ground. And the 30th year had given him the specific knowledge of the ground and the operation that 30 years of farming the same land produced. The knowledge included knowing what the farm could sustain financially through a difficult period and what it could not sustain, a knowledge that 30 years of good years and difficult years had built into his planning in the way that experience builds things into planning. The 0% offer had been the first equipment financing offer in Harold's experience that had made the replacement arithmetic look favorable in a 17% interest rate environment. Harold Beckett was 67 years old in the winter of 1981 and had been farming the same 340 acres of Greenbrier County bottomland and hillside since 1951. 30 years of grain and hay and the cattle that the hay supported, farming the kind of mixed operation that the mountain farm country of West Virginia required, and that produced the kind of income that was adequate in the good years and difficult in the bad years, and that had been, through 30 years, enough to keep the farm in the family and the mortgage paid and the equipment running. His primary tractor, a 1970 John Deere 4020, had given 11 years of service and was reaching the point at which the accumulated maintenance cost was approaching the cost of a new machine when the new machine could be had on favorable terms. The 0% offer was favorable terms. Harold had done the arithmetic on the 0% deal during the drive back from Lewisburg to the farm outside Roncevert, 40 minutes of driving through the Greenbrier Valley, thinking about whether the deal made sense. The arithmetic had said it made sense if the grain prices and the cattle prices held at something close to what they had been in the last 2 years. The arithmetic had said it did not make sense if the prices dropped significantly and the note had to be serviced from reduced income. The prices had been dropping, not dramatically, but progressively, and the dropping had been in his observation since the middle of 1981. He had a nephew named Carl Beckett who worked in the loan department at a Charleston bank, and who had been Harold's source of financial perspective on the farm finance questions that Harold encountered over the years and that his agricultural experience did not fully address. He had called Carl that evening. Carl Beckett had been working in the loan department of his Charleston bank for 12 years when Harold called in the winter of 1981, and the 12 years had given him the specific knowledge of agricultural lending in West Virginia that a loan officer accumulates when the region's agricultural sector is a significant portion of the bank's loan portfolio. He had been watching the Roncevert Federal Savings and Loan with the specific attention that bankers give to institutions whose practices they consider outside the conservative range that difficult environments required. Because the Roncevert Federal's aggressive growth in the agricultural loan portfolio in 1979 and 1980 had been growing at a rate that Carl did not think was consistent with the underlying quality of the collateral the institution was accepting. The agricultural collateral in Greenbrier County in 1979 and 1980 had been the agricultural collateral of an expanding agricultural economy, collateral whose values reflected the commodity prices and the land values of the expansion period rather than the values that a less favorable period would produce. Carl had seen this pattern before in the loan department work, the pattern of institutional growth in a favorable period that outpaced the institution's capacity to manage the portfolio when the favorable period ended. He had told Harold about it in the specific terms that a nephew who works in banking uses when he is talking to a farming uncle who needs practical guidance rather than financial theory. Carl had been direct. He had said the 0% promotion from the manufacturer's finance division was a legitimate offer and that the terms were as described. He had also said that the specific savings and loan institution in Lewisburg that was administering the John Deere credit program in the county was an institution that he had been watching with concern, because the institution had been growing its agricultural loan portfolio in ways that were not well matched to the asset quality of the agricultural collateral it was accepting. He had said that in the current rate environment and with the agricultural prices softening the way they were, the institution's portfolio was going to be under stress within the next 18 to 24 months, and that stress in the agricultural lending portfolio typically produced stress for the borrowers whose notes the institution was carrying. Harold had asked what that meant in practical terms. Carl had said it meant that when an agricultural lending institution was under regulatory pressure, it sometimes called notes that were technically current but that it wanted off its books to reduce its exposure, and that notes called unexpectedly at the wrong time in the farming year were the kind of thing that could put a farming operation in a difficult position. Harold had said he understood. He had driven back to Lewisburg the next Tuesday and had told Gene Prater that he appreciated the offer but that he was going to pass. Gene Prater's response to Harold's Tuesday visit and his decline to purchase had been the professional response of a salesman who has had a second conversation with a customer who was on the verge of buying at the first conversation and who has come back to say he is not going to buy. Gene had presented the additional reasons for the purchase that a salesman presents when the initial terms have been declined. The specific arguments about the machine's capability and the value the financing represented, and the timing of the promotional period that was going to end and would not be renewed at the same terms. Harold had listened to all of it with the patience of a man who had already made his decision and who was being polite in the listening rather than genuinely reconsidering. He had then said the terms were the problem and not the price. And Gene had not followed this, and Harold had said he was not going to finance. The specific directness of Harold's West Virginia mountain character had not produced a longer explanation than the situation required. He had said what he meant. He had meant what he said. Gene had been disappointed and had said the terms were genuinely good and that the 4,240 was the right machine for a 3-100-and-40-acre Greenbrier County operation. Harold had said he knew the terms were good and that the machine was right. He had said the terms were the problem, not the price. Gene had not followed this. Harold had said he meant he was not going to finance and that if he was going to replace the 4,020, he needed to find something he could pay for. He had found it the following spring at an equipment auction in Pocahontas County, a 1966 Farmall 1256 diesel that had been traded into the local IH dealer and that had come to the auction when the dealer had not been able to move it. The $940 had required two decisions on Harold's part before the Pocahontas County equipment auction had produced the opportunity to spend them. The first decision had been the decision to build the operating account reserve for equipment replacement rather than drawing down the account to the minimum that day-to-day operating required, a decision he had made 5 years earlier when the 4,020 had reached the age at which the replacement planning was appropriate. The second decision had been the decision to accept whatever used equipment his operating account reserve could buy, rather than waiting for a deal on new equipment that would require financing. Both decisions had been shaped by the same underlying principle, which was the principle that Greenbrier County mountain farming had been teaching the farmers who paid attention to it for a century, which was that the farming that survived the down years was the farming that had not committed fixed obligations against the variable income that the mountains and the commodity markets produced. The 4,020 that Harold had been replacing had been purchased new in 1970 on a note that had been paid off by 1,975, and the 5 years of payment-free farming from 1975 to 1980 had been the 5 years that had built the operating account reserve to the level that $940 was available for the Pocahontas County auction. He had paid $940. The $940 had come from the operating account, which Harold had been building through the better years, specifically against the equipment replacement that he had known was coming. The Ronceverte Federal Savings and Loan had been established in 1963 as one of the savings and loan institutions that the Kennedy administration's housing and community development programs had encouraged to form in underserved rural areas, institutions that were designed to provide mortgage and savings services to communities that the commercial banks of the era were not adequately serving. The institution had grown through the 1960s and 1970s as the Greenbrier Valley's economy had developed and had expanded its mission from residential mortgage lending to agricultural equipment lending in the late 1970s, when the federal savings and loan regulatory framework had been relaxed to allow thrift institutions to engage in a broader range of lending activities. The agricultural equipment lending had been the institution's participation in the specific financing programs that the equipment manufacturers were supporting through regional savings and loan partners, programs that gave the manufacturers access to the distribution of their 0% promotional financing through the thrift institution's existing customer relationships in the agricultural community. The expansion had been rapid relative to the institution's capacity to manage the additional portfolio, and the agricultural collateral that the institution was accepting had been valued at the 1979 and 1980 prices rather than the prices the early 1980s were producing. Carl had seen this from the Charleston Bank's perspective. Harold had acted on what Carl had seen. The Ronceverte Federal Savings and Loan Bureau, which was the institution that had been administering the John Deere Credit Program in Greenbrier County, was placed under Federal Home Loan Bank Board regulatory supervision in October of 1983. The supervision had followed the specific pattern that Carl had described. The institution's agricultural loan portfolio had deteriorated through 1982 and into 1983, as the grain and cattle prices had continued to soften and as the interest rate environment had maintained the pressure that made agricultural debt service difficult, and the deterioration had produced the capital adequacy concerns that the regulatory framework required the Federal Home Loan Bank Board to address. The four operations situations were different in their specific details, but shared the common element that the 0% promotional terms had been available through the Ronceverte Federal, and that all four had used them in the 1982 period when the terms had been making the equipment purchases accessible that the 17% standard rate environment had been making inaccessible. The 0% terms had been the legitimate terms of a legitimate offer, and the four operations had done nothing wrong in accepting them. The terms had been as represented at the time they were accepted. The problem had been in the institution rather than in the terms, and the problem in the institution had not been visible to the borrowers at the time of the borrowing because the specific indicators of the problem were the indicators of an agricultural lending portfolio that was growing faster than the institution's management capacity, and that was accepting collateral at values that the subsequent market would not support. The borrowers had not been in a position to evaluate these indicators. Carl Beckett had been in a position to evaluate them because his professional context had given him access to the banking community's assessment of the prostitution's practices, an assessment that was available inside the banking community before it was available as public information. Harold had the access to Carl for farming operations in the immediate Ronceverte area, had notes through the Ronceverte Federal Savings and Loan from equipment purchases they had made in 1980, 1981, and 1982 using the 0% program, and two of them had been contacted by the institution's regulatory management about their loan status in the spring of 1984. The specific worst moment that note status discussions could arrive at, the moment when the planting season was beginning and every financial resource was committed to the seasonal inputs. One of the four, a man named Dwight Urell, who farmed 200 acres of bottomland south of Ronceverte, had his note called outright in May of 1984 when the regulatory management had determined that the collateral value of the equipment he had purchased had deteriorated below the note balance, and that the loan did not meet the revised standards the regulatory management was applying. Dwight had not been able to refinance on terms he could service, and the equipment had been repossessed. The watching had not been comfortable watching, because the men who were experiencing the regulatory supervision and the note discussions and Dwight Yarrell's equipment repossession were men Harold had known for years, and whose situations he understood in the specific way that farming neighbors understand each other's situations. He had not celebrated their difficulties. He had watched with the specific sadness of a man who understands why something bad is happening to someone and who wishes it were not happening but cannot change it. He had also watched with the specific understanding of a man who knows that the difference between his situation and the affected neighbor's situation was a decision made in the winter of 1981. A decision that could have gone the other way if Harold had not called Carl. He had called Carl. Carl had told him what he knew. Harold had acted on what Carl had told him. The acting had produced the difference. The difference was visible in 1984 in the specific and difficult way that differences produced by decisions become visible when the consequences of the alternatives become clear. Harold watched all of this from the specific vantage point of a man who had made the decision Carl had recommended 18 months before the regulatory supervision had begun. He had continued to farm with the 1256 through 1982 and 1983 and 1984, and had continued to produce the grain and hay and cattle that the Greenbrier County bottomland and hillside produced under his management, and had not had a note called because he had no note to call. But the version of this story that included only that Harold survived while his neighbors struggled would be an incomplete accounting of what the Ronceverte Federal Savings and Loans collapse had produced in Greenbrier County. The complete accounting included what had happened to Dwight Yarl's farm after the repossession. Dwight had lost the farm in the fall of 1984, when the combination of the equipment repossession and the operating account stress that had preceded it had left him without the resources to continue the operation through another season. The farm had gone to the Ronceverte Federal Savings and Loan as the primary lender's collateral recovery. The Ronceverte Federal was in regulatory supervision and was being managed to wind down its portfolio, and the Yarl farm had been one of the assets it was looking to liquidate at whatever price the market would offer. The purchase of the Yarl bottomland had been a decision that Harold had made in the fall of 1984, when the Ronceverte Federal's regulatory management had been marketing the farm assets it needed to liquidate, marketing them at the distressed prices that a regulated institution selling assets to reduce its exposure was forced to accept when the market for those assets was at the bottom of the cycle that the farm crisis had produced. Harold had not been looking for an opportunity when the Ronceverte Federal's asset sales had been announced. He had been farming his 340 acres and had been watching the crisis resolve around him. The Yarl bottomland, at $48 per acre, had been the announcement that had changed his thinking from not looking to looking, because $48 per acre for Greenbrier County bottomland was a price that Harold's 30 years of watching the Greenbrier County land market told him was a price that the market had not set at anything close to $48 in his memory. He had called Carl. Carl had said the price reflected the regulatory sale conditions and was likely to be the lowest price comparable bottomland would trade at for many years in either direction. Harold had made the offer. The Ronceverte Federal's management had accepted it. The 60 acres had joined the Beckett farm. Harold had bought it. Not the whole 200 acres, because the whole 200 acres was beyond what he could pay from the operating account and the land savings he had been building. He had bought 60 acres of the bottomland, the most productive portion of the Yarl farm, at the price that the Ronceverte Federal's regulatory management was willing to accept for a cash sale that would take the asset off the books quickly. The specific dynamics of the Ronceverte Federal's asset sale in 1984 were the dynamics of a regulated institution, selling assets under pressure, a condition that produces prices that are below the market value of the assets for several specific reasons. The first reason was that the regulatory management was accountable to the regulatory body for the speed of the portfolio reduction, which meant that it was prioritizing the closing of transactions over the maximization of the price received for each transaction. The second reason was that the buyer pool for agricultural land in 1984 was smaller and less capitalized than the buyer pool in normal market conditions, because the farm crisis had reduced the number of farming operations that had the cash reserves to make land purchases and had reduced the confidence of those that did about whether land prices had yet reached the bottom. Harold had been in the small minority of operations that had the cash reserves, because the $940 1256 purchase and the avoided note had preserved the operating account reserves that the crisis years had depleted in the operations that had been carrying equipment debt. The confidence had come from Carl's assessment, which was the assessment of a professional with a specific view of the agricultural lending situation, that told him the bottom had been reached or was close to it. The combination of the cash availability and the professional confidence had produced the $48 PACRE offer. The Ronceverte Federal's management had accepted it because it was cash and it was closing quickly, and those two attributes were more valuable to the regulatory management than the price. The price had been $48 per acre, which was approximately 40% of what the land had been appraised at before the farm crisis had compressed Greenbrier County land values. Harold had paid $2,880 for 60 acres of bottomland that, once the regulatory crisis had stabilized and the land values had recovered, would be worth substantially more than he had paid. The recovery of Greenbrier County land values from the 1984 crisis lows to the pre-crisis range had followed the pattern that agricultural land value recoveries followed in regions where the underlying land quality and the agricultural productivity of the land were the fundamental drivers of the long-term value, which was the pattern of a recovery that was slower than the decline had been, but that eventually returned to the range that the land's agricultural productivity supported. The specific characteristics of Greenbrier County bottomland, the alluvial soil quality and the water availability, and the hay and grain productivity that the bottom ground produced, were characteristics that had not been permanently changed by the farm crisis and that continued to produce the agricultural income that made the land worth what the land market eventually reflected. Harold had known this when he had made the offer on the Yarrell bottomland in the fall of 1984. He had not known specifically when the recovery would occur or at what price level it would settle. He had known that $48 per acre for Greenbrier County bottomland was a price that the land's agricultural productivity would eventually support multiples of Pochels, and that the timeline of the eventual recovery was uncertain, but the direction of the eventual recovery was not. Carl had confirmed this assessment when Harold had called before making the offer. Harold had made the offer. The recovery had occurred on the schedule that the land's fundamental value had predicted, rather than the schedule that impatience or pessimism might have projected. By 1989, the land had recovered. The land had recovered by 1989, when the Greenbrier County land market had normalized and when comparable bottomland was selling at prices that were back in the range of pre-crisis values. Harold had not sold it. He had farmed it. The 400 acres that his farm had become, the original 340 plus the 60 acres purchased from the regulatory sale, had been the farm that Harold had farmed through the late 1980s and into the 1990s, and the additional 60 acres had been the most productive land in the expanded operation because the bottomland quality of the Jarl acres matched the best of Harold's own bottom ground. Gene Prater had heard about the land purchase in 1984 and had said to Harold, the next time he saw him, at the Lewisburg Co-op, that it seemed like the situation had worked out better than Gene would have expected when Harold had passed on the 0% deal. Harold had said he supposed it had. Gene had said Harold must have known something he had not known. Harold had said he had called his nephew, and that his nephew had known something he had not known. Gene had said that was the same thing. The conversation between Harold Beckett and Gene Prater at the Lewisburg Co-op in 1984 or 1985, whenever it had occurred, was the conversation that closed the loop on the winter 1981 showroom visit and Gene's subsequent disappointment at the declined purchase. Gene had been honest in the way that honest salesmen are honest when the customer who declined to buy has turned out to have been right to decline, which was to acknowledge the outcome without making a larger claim about the customer's foresight than the outcome justified. Harold had been honest in the way that honest farmers are honest when they have made a decision that worked out well, which was to give the credit to the person who had provided the information that made the decision possible, rather than to accept the credit for superior personal wisdom. He had not known that the Ronceverte Federal was going to be placed under regulatory supervision in October of 1983. Carl had not known that specifically either. What Carl had known was the pattern of an institution's agricultural lending portfolio growing in ways that were inconsistent with the underlying collateral quality, and the historical outcome of that pattern when the market conditions changed. The outcome had been consistent with the pattern. Harold had been out of the pattern because he had called Carl, because Carl had explained the pattern, because Harold had listened. Harold had said he guessed it was the 1966 Farmall 1256 had been running on the Harold Beckett farm in Greenbrier County, West Virginia. Through all of this, through the supervision years and the land purchase and the farm expansion and the years of farming the expanded 400 acres, it had been maintained by Harold in the specific way that the farm equipment of a man who had been maintaining farm equipment for 30 years was maintained. The seasonal service and the attention to developing problems and the specific knowledge of the machine's character that 30 years of maintaining machines produced. The specific maintenance history of the 1966 Farmall 1256 in Harold Beckett's ownership from 1982 to 1991 was the maintenance history of a man who had learned to maintain farm equipment by maintaining farm equipment for 30 years, and who applied the same standard to the 1256 that he had applied to every piece of equipment he had owned. The 1256 had received the annual service that the seasons required, the end-of-season service that prepared it for storage, and the spring service that prepared it for the work ahead, and the specific attention to developing problems that the operation of a piece of equipment over time produced in a man who was paying attention. It had required one major repair in the 9 years, the clutch replacement that the Pocahontas County miles and the Greenbrier County farming had eventually required, a repair that Harold had done with a local mechanic in Ronceverte who knew the 1256 and had done the work over 2 weekends for a parts and labor cost that Harold had accepted as appropriate. The repair had been done when the clutch had shown the signs of wear that meant it was approaching the end of its service life, rather than waiting until it failed, because Harold had been farming long enough to know that maintaining to prevent failure rather than repairing. After failure was what kept the machines running at the moments when running was required. The 1256 had kept running at the moments when running was required. By 1991, the 1256 was 25 years old and had been in Harold's ownership for 9 years and had been worked through the difficult years of the farm crisis and the better years of the late 1980s, without the specific failure that would have required the emergency repair that no operating note would have complicated. This is worth saying clearly, because the 1966 Farmall 1256 in Harold Beckett's Greenbrier County farming was not a machine that was running despite its age or that was surviving through heroic maintenance efforts. It was running because it was the right machine for the application, maintained at the appropriate standard by a farmer who had 30 years of experience with farm equipment and who understood what the maintenance standard required. The 1256 was not the best machine for a 400-acre mixed grain hay and cattle operation in Greenbrier County in 1991. The best machine for that operation would have been a more capable, current model diesel with the hydraulics and the cab and the electronic controls that the equipment of the early 1990s offered. But the best machine was not the available machine for the available dollars at the time Harold needed a machine, and the 1256 had been the available machine for $940 in the spring of 1982. The available machine had provided 9 years of service through the years when the best machine would have been sitting on the lot of the Lewisburg John Deere dealer, waiting to be paid for. The available machine had produced enough income to make the Yarrell land purchase possible. The available machine had been the foundation of everything the 9 years had built. It had served. It had served well. That was enough. It had served. The 0% deal had not served, at least not for the farmers who had taken it and whose notes had been called. Harold had survived. His nephew Carl had made the survival possible. The 1256 had been the expression of the survival. The land purchase had been the additional consequence that the survival had made possible. The consequence had changed the farm from 340 acres to 400 acres. It had changed the farm from a farm that was managing through the crisis to a farm that had grown during it. That was the full accounting. The dealer had offered 0%. The bank had collapsed. Only the cash buyer survived, and the cash buyer had done more than survive. The cash buyer had grown. The story of Harold Beckett's surviving the Ronceverte Federal Savings and Loans collapse and then buying the Yarrell bottomland from the regulatory sale is not, at its core, a story about financial cleverness. It is a story about the value of having someone in your network who understands the financial environment that your farming decisions exist in and who is willing to tell you what they see clearly enough for you to act on it. Harold had that person. Carl had the professional context that the loan department work had produced. The 12 years of watching agricultural lending in West Virginia and the specific familiarity with the patterns that institutional stress in agricultural lending produced. The specific piece of information that mattered, the piece about the Ronceverte Federal's agricultural portfolio growth and the collateral quality concerns, was not information that was publicly available in the winter of 1981. It was information that was available inside the banking community's professional assessment of the institution's practices. Harold had access to that information because he had a nephew in the banking community, and because he was in the habit of calling the nephew before making significant financial decisions. The habit was the thing, not the genius of the farmer who saw what the experts missed, not the superior wisdom of a man who understood financial instruments better than the people selling them. The habit of calling the person who had the relevant information before signing the paper, that was the whole of what had made the difference between Harold's situation and Dwight Yarrell's situation, and the whole of what had made the land purchase possible. The habit had been the foundation of everything. That was what surviving looked like when the surviving was done right. Harold Beckett's relationship with Gene Prater at the Lewisburg John Deere dealership had spanned the full 22 years of Gene's tenure in the county. From the early 1960s, when Harold had bought parts and service from the dealership, to the various equipment purchases and near purchases that the relationship had produced over those years. The winter 1981 visit and the subsequent declined purchase had not damaged the relationship, because Gene was a professional who understood that not every customer who came to look at equipment was going to buy equipment, and that the customers who came back were customers worth maintaining the relationship with. Harold had come back. He had come back for parts and service on the 1256, which Gene's dealership did not support as an international harvester machine, but which had a local IH mechanic connection that Gene knew and could refer. He had come back in 1985 when Harold had bought a used John Deere implement for the expanded operation and had dealt with Gene's dealership for the transaction. He had come back in the early 1990s when the primary tractor replacement was finally made and the new machine had come from Gene's dealership. The relationship had continued. The winter 1981 visit had been an episode in the relationship rather than the end of it. Gene had maintained the professional graciousness that good relationships require. When one party has made a decision, the other would have preferred to be different. Harold had maintained the customer relationship with the dealership that served his equipment needs in ways that a 340-acre and then a 400-acre Greenbrier County operation required. Both parties had kept their respective commitments to the relationship. The relationship had endured. The farms that had taken the 0% deal in 1981 and 1982 had not all endured. That had been the difference, not the relationship between Harold and Gene. The relationship between Harold and Carl, and the decision it had produced. The Pocahontas County equipment auction, where Harold had bought the 1256 in the spring of 1982, had been one of the periodic agricultural equipment auctions that the mountain counties of West Virginia ran to provide the used equipment market that the region's farming operations depended on. The 1256 had been on the auction list because an IH dealer in the county had taken it in as a trade-in and had found no buyer for it at his asking price over 2 seasons, and had consigned it to the auction rather than continue carrying it in his inventory. Harold had been to the Pocahontas County auction twice before, in 1974 and in 1978, looking for specific pieces of equipment and not finding what he needed at prices he could accept. And the 1982 visit had been the visit where the piece and the price had aligned in the way they occasionally aligned when you were patient enough to wait for the alignment. The 1256 had been the alignment, $940, 25 miles of Greenbrier Valley Road back to the farm. A year of the specific mechanical attention that a tractor that had been sitting in dealer inventory requires after the service intervals have been allowed to slip, and then a decade of the farming work that the 340 acres required and the 400 acres would require after 1984. The auction had been the beginning of the alignment. The work had been the expression of it. The land purchase had been the consequence of it. Everything else had followed. Carl Beckett's professional assessment in the winter of 1981 had been the presentiment of a man who had been watching the specific pattern of the Ronceverte Federal's behavior for approximately 18 months before Harold called. He had been watching it, not because the Ronceverte Federal was one of his bank's borrowers or competitors, but because the banking community in West Virginia was small enough that the practices of the different individual institutions were visible to the people working in the industry, and because the Ronceverte Federal's agricultural lending growth in 1979 and 1980 had been visible enough to be the subject of professional conversation. The professional conversation had been the conversation that banking professionals had with each other at the quarterly meetings and the continuing education programs that the State Banking Association organized. Conversation that was not public information but that was available to the participants, and that had been producing the specific concern about the Ronceverte Federal that Carl had ascribed to Harold. The concern had been warranted. The institution had been placed under regulatory supervision within 2 years of the professional conversation that had informed Carl's assessment. The assessment had been correct. The timing of the correctness had been uncertain. The direction of the correctness had not been. Carl had told Harold what he knew. Harold had acted on what Carl told him. The acting had been the whole of the rest of the story. The Greenbrier County farming community's experience of the 1983 and 1984 farm crisis years had been the experience of a mountain farming community dealing with conditions that had been shaped by national, agricultural, and monetary policy in ways that the individual farming decisions of individual Greenbrier County farmers could not control, but that those individual decisions could position themselves for or against. The positioning decisions had been made years before 1983, in the specific equipment purchases and the financing choices and the operating account management that the individual farm operations had been making through the 1978 to 1982 period when the agricultural expansion was at its height, and the specific risk that the expansion represented was most difficult to see. The farms that had been positioned conservatively, with limited equipment, debt, and adequate operating reserves, had experienced the 1983 and 1984 conditions as difficult years but manageable ones. The farms that had been positioned at the margin of their financial capacity, with equipment debt that required commodity income at or above the expansion period's prices to service, had experienced the 1983 and 1984 conditions as the conditions that made the margin unavailable and the position unsustainable. Harold had been in the first category. Dwight Yarrell had been in the second. The difference between the two categories had not been the result of superior virtue or superior intelligence on Harold's part, and inferior virtue or inferior intelligence on Dwight's. The difference had been the specific financial information that Harold had through his relationship with Carl, and that Dwight had not had through any comparable relationship. The information had been the difference. The relationship had been the access to the information. The habit of calling before signing had been the access to the relationship. Harold Beckett's relationship with Gene Prater at the Lewisburg John Deere dealership had spanned the full 22 years of Gene's tenure in the county. From the early 1960s, when Harold had bought parts and service from the dealership, to the various equipment purchases and near purchases that the relationship had produced over those years. The winter 1981 visit and the subsequent declined purchase had not damaged the relationship, because Gene was a professional who understood that not every customer who came to look at equipment was going to buy equipment, and that the customers who came back were customers worth maintaining the relationship with. Harold had come back. He had come back for parts and service on the 1256, which Gene's dealership did not support as an international harvester machine, but which had a local IH mechanic connection that Gene knew and could refer. He had come back in 1985 when Harold had bought a used John Deere implement for the expanded operation and had dealt with Gene's dealership for the transaction. He had come back in the early 1990s when the primary tractor replacement was finally made and the new machine had come from Gene's dealership. The relationship had continued. The winter 1981 visit had been an episode in the relationship rather than the end of it. Gene had maintained the professional graciousness that good relationships require. When one party has made a decision, the other would have preferred to be different. Harold had maintained the customer relationship with the dealership that served his equipment needs in ways that a 340-acre and then a 400-acre Greenbrier County operation required. Both parties had kept their respective commitments to the relationship. The relationship had endured. The farms that had taken the 0% deal in 1981 and 1982 had not all endured. That had been the difference, not the relationship between Harold and Gene. The relationship between Harold and Carl, and the decision it had produced. The Pocahontas County equipment auction, where Harold had bought the 1256 in the spring of 1982, had been one of the periodic agricultural equipment auctions that the mountain counties of West Virginia ran to provide the used equipment market that the region's farming operations depended on. The 1256 had been on the auction list because an IH dealer in the county had taken it in as a trade-in and had found no buyer for it at his asking price over 2 seasons, and had consigned it to the auction rather than continue carrying it in his inventory. Harold had been to the Pocahontas County auction twice before, in 1974 and in 1978, looking for specific pieces of equipment and not finding what he needed at prices he could accept. And the 1982 visit had been the visit where the piece and the price had aligned in the way they occasionally aligned when you were patient enough to wait for the alignment. The 1256 had been the alignment, $940, 25 miles of Greenbrier Valley Road back to the farm. A year of the specific mechanical attention that a tractor that had been sitting in dealer inventory requires after the service intervals have been allowed to slip, and then a decade of the farming work that the 340 acres required and the 400 acres would require after 1984. The auction had been the beginning of the alignment. The work had been the expression of it. The land purchase had been the consequence of it. Everything else had followed. Carl Beckett's professional assessment in the winter of 1981 had been the assessment of a man who had been watching the specific pattern of the Ronceverte Federal's behavior for approximately 18 months before Harold called. He had been watching it not because the Ronceverte Federal was one of his bank's borrowers or competitors, but because the banking community in West Virginia was small enough that the practices of the individual institutions were visible to the people working in the industry, and because the Ronceverte Federal's agricultural lending growth in 1979 and 1980 had been visible enough to be the subject of professional conversation. The professional conversation had been the conversation that banking professionals had with each other at the quarterly meetings and the continuing education programs that the State Banking Association organized. Conversation that was not public information but that was available to the participants, and that had been producing the specific concern about the Ronceverte Federal that Carl had ascribed to Harold. The concern had been warranted. The institution had been placed under regulatory supervision within 2 years of the professional conversation that had informed Carl's assessment. The assessment had been correct. The timing of the correctness had been uncertain. The direction of the correctness had not been. Carl had told Harold what he knew. Harold had acted on what Carl told him. The acting had been the whole of the rest of the story. The Greenbrier County farming community's experience of the 1983 and 1984 farm crisis years. Dwight Urell's situation in the fall and winter of 1984 had been the situation of a man who had done nothing wrong, who had made the decision that most of the competent farmers in Greenbrier County had made when the 0% offer had been available, and who had found himself in the position that Carl had described as the risk of carrying notes with an institution that was under regulatory stress. He had lost 200 acres of Greenbrier County bottomland that his family had farmed for 22 years. The loss had not been his fault in any moral sense. It had been the result of a confluence of factors that had not been visible to him from the position of a farmer evaluating an equipment financing offer in 1981. Factors that had been partially visible from the position of a banker evaluating an agricultural lending institution's portfolio quality in the same period. Harold had had access to the banker's perspective. Dwight had not. The difference had been the phone call. The phone call had been the difference between the farm that survived and the farm that did not. Harold had not sought out the phone call as a defensive measure against a risk he had specifically identified. He had made the phone call because he had a habit of calling Carl before significant financial decisions and because replacing the primary tractor was a significant financial decision. The habit had been the protection. The habit had not been designed as protection. It had simply been the practice of a cautious man who knew that his agricultural expertise had limits and who had found a resource for the financial expertise that was outside those limits. The habit had been the thing. Dwight Urell's situation in the fall and winter of 1984, the arithmetic that Harold had done. During the 40-minute drive from Lewisburg to the farm outside Ronceverte in the winter of 1981 had been a specific arithmetic that reflected his 30 years of Greenbrier Valley farming experience. He had calculated the monthly note payment against the monthly grain and cattle income that the 340 acres produced in an average year and in a bad year, and had found that the average year supported the note payment and the bad year did not, and had asked himself what the Greenbrier Valley farming climate said about the frequency of bad years. The answer was that bad years in Greenbrier County were not rare anomalies to be discounted in planning, but regular occurrences to be planned for, because the mountain farming climate and the commodity market cycles produced bad years with a specific frequency that mountain farming experience documented and that 3 decades of Greenbrier County farming had confirmed. A note that the average year supported but the bad year did not was a note that was going to produce difficulty roughly as often as the bad years came. And in Harold's experience, the bad years came approximately 1 in 4 or 1 in 5. Often enough that planning as though they would not come was planning that would eventually be wrong. He had been planning for 30 years on the assumption that bad years would come. The planning had worked through 30 years of Greenbrier Valley farming. The assumption had been validated every 4 or 5 years by the actual occurrence of the bad year. The arithmetic had said the note was not safe for the farming's actual pattern. Carl had confirmed the arithmetic and had added the institutional dimension. Harold had declined. The arithmetic and the institution had both been correct. The declining had been the right decision. The 1256 had been the implementation of the right decision. The land purchase had been the consequence. The 400 acres had been the farm. Harold Beckett continued to farm the 400-acre Greenbrier County operation through the late 1980s and into the 1990s, and the operation that the 400 acres represented was a different operation from the 3-100-40-acre operation he had been running when Gene Prater had shown him the 4,240 in the winter of 1981. The 60 acres of Yarrell bottomland had been the land that had come from the wrong decisions, consequences, the land that had been available because Dwight Yarrell had taken the 0% note and had lost the farm, land that Harold had been able to buy because he had not taken the 0% note and had kept the operating account intact. Harold did not think of it in those specific terms. He thought of it as the South Bottomland, which was what it was called in the farm operations records, and he farmed it with the same attention he farmed the rest of the ground. The 1256 was still on the farm when Harold turned the primary management over to his son in the mid-1990s, not as the primary machine. The primary machine by then was a newer tractor, purchased when the finances had supported it on terms that the finances could sustain. But the 1256 was still there. $940, still working when it was needed. Gene Prater retired from the Lewisburg John Deere dealership in 1993. He had been selling farm equipment in Greenbrier County for 34 years. He had learned more from the customers who did not buy than from the customers who did, because the customers who did not buy had reasons, and the reasons were usually the reasons that the smart farmers had for making the decisions the smart farmers made. Harold had had a reason. Carl had provided it. The reason had been right. The 1256 had been the expression of the reason. The 400 acres had been the consequence of the reason being right. The dealer had offered 0%. The bank had collapsed. The cash buyer had survived and had grown. That was the full accounting. That was what Greenbrier County, West Virginia produced when the right farmer had the right information and acted on it. The mountains had seen it before. The mountains would see it again. That was how mountain farming worked. You survived because you built for survival before the test arrived. Harold had built for survival. The test had arrived. Harold had survived, and then some. The specific character of the Greenbrier Valley as a farming environment had shaped the specific character of the farming community that had been working it for generations, shaped it in the way that demanding environments shape the communities that persist in them, toward the specific virtues of caution and patience and the maintenance of reserves that mountain farming required, because mountain farming did not forgive the overextension that the flatland farming country sometimes survived. Harold had those virtues. He had them from farming 30 years in the valley and from watching what happened to operations that did not have them. He had also had the specific additional resource of his nephew in Charleston, a resource that had turned the virtues into a specific decision at a specific moment in 1981, when the decision had mattered more than it was possible to know at the time. The three things together, the virtues, the resource, and the decision, had produced the 400-acre farm that Harold's son was managing in the 1990s. The 1256 had been the physical expression of the decision. $940, still running, still expressing. Gene Prater had been right that the 4,240 was the machine the operation needed. He had been right about that. Harold had been right that the $940 1256 was the machine the situation required. He had been right about that. Both of them had been right. The difference was that Harold's right had included the next 3 years and the land purchase and the 400 acres. Gene's right had included what the machine could do. Harold's right had included what the machine could do and what everything around the machine was about to produce. That was the difference between the right machine and the right decision. The 4240 was the right machine. The 1256 was the right decision. The right decision had survived. The right machine's buyers had not, in some cases. That was what the bank's collapse had revealed. That was what only the cash buyer's survival had demonstrated. The mountains had seen it before. They would see it again. The cash buyer survives. That was the mountain farming truth. Harold had known it. Carl had confirmed it. The 1256 had expressed it. The 400 acres had proved it. Lewisburg, West Virginia. Winter 1981. A showroom floor. A 0% offer. A 40-minute drive home thinking about it. A phone call to a nephew in Charleston. A conversation that lasted 20 minutes. A decision that lasted 30 years. $940 for a 1966 Farmall 1256. The bank that offered 0% went under in 1983. The cash buyer bought 60 acres from the bank's liquidation in 1984 for $48 per acre. The cash buyer farmed 400 acres instead of 340. The cash buyer survived. The cash buyer grew. That was the full accounting. The dealer offered 0%. The bank collapsed. Only the cash buyer survived, and then some. The mountains saw it all. The mountains always do. The people who farm them learn what the mountains teach, or they move on. Harold had learned. He had farmed. He had stayed. The 1256 had stayed. The farm had grown. The mountains had seen it all, as they always do.